Good morning, everyone. Welcome to the Genghis Weekly Investor Briefing. The faceless woman, or the woman with no face, is Damaris Mukulu, the head of brand marketing and communications at Genghis Capital. We're very glad that so many of you could join us this morning. It's August 9th. Super excited for a new month, and hopefully the outlook for the week is just as promising. As always, we're going to be reviewing the fixed income market. In this regard, we're talking about treasury bills and bonds. So the Genghis research team is going to tell us about the performance of these two instruments and also the buys or recommendations for the week. We're also going to be reviewing the Kenyan equities market. This is in terms of the Nairobi Securities Exchange. They're going to tell us about the performance last week and what we can anticipate from the different counters this week. The Genghis Weekly Investor Briefing is interactive. We really enjoy when you send us in your questions and comments. So we encourage you to use the Q&A tab at the bottom of your screen to send in your questions. And then our team that is comprised of Melody and Wesley, they'll be able to address these questions at the end of the session. If you have any comment or concern, please also feel free to use the chat box. So I think that does it for the pleasantries and introductions. I'm going to hand it over to our capable research analysts, Melody and Wesley, and we can kick off this Monday on a high note. Over to you guys.
Thank you, Damaris. Let me just share my screen.
Good morning to you. Today we'll start with the equity bits. The market closed the week relatively positive as reflected by the 60 basis point uptick in the Nairobi All-Share Index. Volumes, however, declined 11.9% week on week to a turnover of 1.49 billion. On the top gainers, we had Unga Group up by 17.39% on Friday's close. It's worth to note that the counter has gained about 5.1% since its disclosure of Enns Valley Bakery entering into an asset repurchase agreement with Bicol. Also, Unga Group announced conditional investment agreements between two of its subsidiaries, Unga Farm Care and Unga Millers with Nutrico International. On the top gainers, we also had BK Group, we had Portland's Stand Express, and in the week's laggards we had Nairobi Business Venture, Samia Africa, TP Serena, Kengen, and Transcentury, which earned a spot in the week's laggards. On the foreign participation, we saw foreigners accounting for 43.8% of the week's turnover. They had an overall net outflow position of 237.7 million. And accumulated on equity while exiting on Safaricom, EABL, and Stanchart. Samia Africa released their results, their 1H21 results on Tuesday, that was 3rd August. They reported the earnings per share for the 6-month period in the 30th June at 58 cents. And looking at the top line, revenues declined 26.7% year-on to 323.2 million due to the gradual re-entry into the tire business. Their operating profit for the period under review climbed from 5.1 million to 226.5 million, attributed to by the decline in cost of sales and operating expenses, which were really drastic. For instance, cost of sales were down 86.6% year-on-year, and the operating expense also declined 54% year-on-year. Finance cost for the period also declined by 34% year-on-year, resulting into a 202 million profit before tax for the period. The counter also realized a 14.6% year-on-year growth in its balance sheet to 1.2 billion, and the board did not recommend an interim dividend. Looking at the peer review, Nairobi All-Share Inc. performed its peers on the week-on-week median of 0.1%. The market's price to earnings ratio and its dividend yield were, however, below the African median of 10.7 times and 5.2% respectively. Looking at the corporate calendar, this week is quite an interesting week. The book close of BAT's 3 shillings and 50 cent interim dividend will be on Friday. To you, Melody.
Thank you, Wesley. So I'm going to look at the financial sector highlights. So to start with, the KCB, Equity Standard, Stanbic, and DTB all continued the rally into the week, with equity edging closer to its 52-week high of 50.75 to close at 50 shillings. KCB also edged closer to its 52-week high of 47 to close at 46.75. However, ABSA and I&M closed the week lower at 9.8 and 22.55 respectively. Of note, as we saw in Wesley's slide, Stanbic closed at, there was a rally on the counter which closed at 92.5 from 85 shillings at the beginning of the week. So in the insurance front, CIC closed at 3.1 shillings, up marginally from the start of the week at 3 shillings, with Kenya Re closing at 2.58, which is marginally higher than what it was at the beginning of the week. Investors had bearish sentiments on Jubilee and Sanlam, which were closed at 370 and 10.8 shillings respectively, from 375 and 11.45. So looking at the sector highlights, Kenya is to issue licenses to foreign reinsurance brokers after a law change. So the industry regulator, it requires now that foreign reinsurance brokers who are in Kenya are supposed to start licensing. So the IRA had issued a circular calling on all the reinsurance brokers to have the operations in their countries to set up a physical office and get a license effective January 2022. So this is supposed to be applicable for all the new contracts kicking in from January. So this change in law was put across so that it could protect local players who are using foreign brokers to buy reinsurance products. You might find an instance where maybe a local player sent money and then something happens and they come back to IRA. So I think that's why they came about with this law change. So just a recap, reinsurance basically is insurance for insurers. So it's whereby insurers transfer part of their risk portfolio to other parties to reduce the likelihood of paying a large obligation resulting from claims. So the Finance Act also amended the Insurance Act to remove the requirements to have Kenya Re certify reinsurance contracts. This amendment could have been because they realized that there are many reinsurance players in the sector now, and therefore the need of regulation by, or rather any regulation of reinsurance contracts, is a role for the regulator as opposed to one active market player, which was Kenya Re. Secondly, the risk weighting amendment was done for the weighting for mortgage loans by CBK. So the Central Bank of Kenya published a banking circular to the CEOs, or rather the chief executives of commercial banks and mortgage institutions, to amend the risk weighting from 50% to 35%. Though this will not apply to companies that engage in speculative residential building, property developments. So this, it's expected that this amendment, which will come in force from July 1st, 2021, implies that banks can now lend more towards home ownership at the current levels. So they don't need to go into the market again to raise capital for mortgages, residential mortgages in particular. So it's expected that this change is going to promote the mortgage market, which has added about 10,836 mortgage loans in 10 years yet the annual demand for housing is just 200,000. So this change, together with the KMRC coming to effect from 2020, is supposed to boost the mortgage sector in Kenya. So just a side note, it's not on the slide, but the National Assembly Departmental Committee on Finance and National Planning approved the CBK Amendment Bill 2021, and it's now before Parliament for debate and approval by Parliament. So the committee added the clause to give the CBK the powers to determine the pricing parameters for digital lenders, which they'll set their cost of credit. So there was a previous proposal on the bill that was proposed that digital lenders should have capital and liquidity requirements. However, this was dropped off because the committee decided that this was actually a prudential requirement by, let's say, a bank. And because this digital credit companies do not take deposits, they came to the conclusion that public funds would not be at risk, so they removed that requirement. So this bill, just to note, is supposed to regulate digital lenders who are not regulated by any other law. That is CMA Act, the Banking Act, and the Insurance Act. Last week, they released the results, half-year results for Kenya Re. So the national reinsurer reported a 66.1 drop in earnings per share to 0.19. So the half-year profit also plunged 69% to 533.7 million as the claims and expenses rose during that period. So gross premiums grew marginally by around 6% year-on-year to 9.6 billion, while investment income declined by 42 basis points to 1.9 billion shillings. So the net claims, on the other hand, rose 23.5% year-on-year to 6.3 billion in the 6 months to June from 5.1 billion. Operating expenses as well edged up 10.8% year-on-year to 1.1 billion shillings, as provisions for doubtful debts also went up more than half, 51.8% to 411.4 million. So this attributed to the rise in total claims, benefits, and other expenses to the 10 billion mark, 9.9 billion. And this is what weighed down on the profit of the company. So the asset base also grew 1.8% year-on-year to 54.2 billion. And looking at the capital adequacy and solvency ratios, they were quite high at 875 and 707 respectively. And the board did not recommend an interim dividend. So just a few things that we saw are also affecting Kenya Re. The firm had said previously in their latest statements that the company is facing risks of domestication of reinsurance markets, of where they operate, competition, and price undercutting. And looking at Kenya Re, they're now trying to diversify their revenue by going into Egypt. They want to set up a Takaful unit. So the insurance is looking to expand its existing customer base, spread its risk, and increase return to shareholders. So for Egypt, they had made some changes to the requirements for capital. That's why they had to issue bonus shares in 2019, which was necessary to access this market. So they're targeting Egypt for Takaful business, given the high Muslim population and financial inclusion. So products such as Sukuk bonds will mean more insurance. So Sukuk bonds are actually Sharia compliant certificates through which investors can gain partial ownership of an issuer's assets. So for Kenya Re, in May 2021, AM Best, which is a ratings company, affirmed the financial strength rating of B, which is fair, and the long-term insurance issuer credit rating, long-term, of BB+, which is fair. So mainly they see a negative outlook on the long-term issuer rating by the poor non-life underwriting profitability. As we've seen, there's increasing claims. And this has been demonstrated by the weaker results than its historical average. So moving on to the trade of the week, we had a long-term buy on Stanchart, mainly due to the impressive growth of its wealth management arm, which grew 90% year-on-year last year to come to close at 129 billion, which is quite impressive. And the digitalization efforts that it has put across, like it's planning to go into digital micro-lending, credit card automation, as well as they updated their ATMs to accept checks. So all this is supposed to support non-interest income. So we know that banks are about to release their half-year results, and that's what we'll be keeping an eye on. So currently the counter is slightly discounted at 0.98 versus 1.01 price to book value, and it has an attractive dividend yield of 8% versus 3.1% of the industry. This is something that income-oriented investors can get into. And that's the end of our presentation. We're waiting to see if Churchill will be able to log in to take us through the fixed income and macroeconomics.
Melody, thanks for your presentation. I think it's better if we just continue to the fixed income segment, since Churchill has not been able to join yet.
May have to give me a minute.
Sure, take two.
So I don't think I'll do it as well as Churchill, but I'll just go through what I have.
Okay, that's fine.
So the National Treasury launched its budget process for the next fiscal year, that's full year 2022-2023, in the course of the week. So the budget process has been rescheduled and to be conducted earlier than the norm, in the light of the general elections that are to be conducted next year, August. So underpinning the full year 2022-2023 budget is a projected real GDP of 5.8% 2022 and 5.9% 2023. Yes, so the draft 2021 budget review and outlook paper report is scheduled to be released at the end of this month. This report will revisit the fiscal outturn of full year 2020-2021 and possibly to recalibrate the budget estimates for the current fiscal year. So specifically, total revenue in full year 2020-21 came at 1.562 billion, which was 99.5 billion lower than the target. And this was dragged down by ordinary revenue and appropriation in aid, whose outturn came at 98.9% and 68.1% respectively. So on the flip side, expenditure, and net lending totaled to 2.75 billion, which is 131 billion shillings lower than the projected expenditure. And this slow absorption of funds was dragged by the subpar disbursements of development expenditure, which was at 597 billion against 668 billion. So the full year 2020-2021 budget outturn, it strengthens the view that the supplementary budget to be priced in the BROP report. So the public hearing of the sector working reports is scheduled for early October. And while the BPS, that's the budget policy statement, is expected to be submitted in the National Assembly in late November. So the full year 2022-2023 draft budget estimates are expected to be submitted in the National Assembly late January 2022, with the budget statements by the CS scheduled for mid-March. The deadline for the presidential assent of the appropriation bill 2022 and the finance bill is scheduled for late March. So for the secondary T-bond market, market activity moderated 5.7% in the week to total at 21.1 billion, As per the recent trends, most of the investor interest was on the short and medium part of the yield curve, attributed to the higher levels of liquidity. So TBL subscription, on the other hand, showed an improved performance with 99.8% at 23.9 billion, which is a slight, of which the yields had a slight uptick in the 91-day and 182-day tenors, with the 182-day now going back above the 7% threshold by the CBK. So the focus of the week will be this month's primary bond auction results, and we expect a healthy subscription against the backdrop of this healthy, elevated liquidity in the market. So the high liquidity was telegraphed by the mop-up effect by the CBK rather, which was the rate was rather muted between interbank at 3.19. It didn't really change much, while the CBK mopped up around 126.18 billion for the 7-day. The bids accepted was 112.63 with a weighted average rate of 5.43%. So from this environment, we believe that subscriptions will be heavy for going forward, more to the 8.1 year paper, which is the FXD 2019-10. So looking at net borrowing, it's gone now to 99.2 billion, which is inclusive of the CPK overdraft, with the domestic borrowing now at 15.1% of the target 658.5 billion. So for the week straight, the bid range for the August 2021 primary bond issue, so it's focusing on the reopening of the FXD3 2019-10, FXD1 2018-10, and the new FXD1 2021, you can see. So the target is 60 billion, which is supposed to be for budgetary support, and investors need to be keen on the withholding tax of 10% for the tenors greater than 10 years. So that's FXD1 2018-20 and FXD1 2021-20. And that should be it. I think we've covered the rest of the presentation.
Thank you, Melody. Thank you, Wesley. I think we can go to the Q&A section to get into the Q&A tab, but I see a couple of questions that have come in the chat box. So the first one is from Ian Wangai. He says, any idea on a buy on NBV after the recent huge price drop? And Melody, maybe you could stop sharing the screen so we can see you in Candid. Oh, and you're on mute as well.
Okay, 1 second.
No worries.
I think Wesley is our NBV expert. He can take us through it.
Awesome.
Yeah, well, the question on the recent price action has been primarily due to the announcements. First, from Delta acquiring 84% stake in NBV. There was a rally. After that, there was change in the business strategy, and now there is an expectation of a change of its portfolio now that they're considering entering into aviation and cement by acquiring the 11.3 hectare land in Mavoko, and also considering all these other acquisitions of Air Direct, of Delta Automobile Limited, Aviation Management Solutions. When you put it into perspective, the rally has primarily been based by pricing in of the news, and now that investors have nothing more juicy to speculate on, you see there is no that excitement on the counter. So, but we still expect some announcement on approvals by the CMA, by the stakeholders, and by NSC. So the counter is still on a speculative. It's still on a speculative so far, because looking at their fundamentals, there is nothing much really that can. We are still for their financials. So at the moment, everything that's happening on the counter is on a speculative move.
All right, Wesley. So speculate away if NBV is a counter of interest. I believe your response also addresses Sylvester Chege's question. Ian also had another one. He's asking about any hope for the I-right. I believe he's talking about the ICA right that's issued on the exchange. Who will be able to tackle that?
I can try. So we saw that. I can say something, then Wesley can add on it. So we saw that the performance was previously affected by the anchor tenant, which was Tuskys at the Greenspan Mall, which saw like the revenue really come down to about 21.8%. So I think with this new new tenant, which is the Naivas supermarket, it should be able to boost their earnings. As at the moment, because of COVID, we know that the real estate market is having a bit of a crunch, but things are going to get better. So we're waiting to see what happens. It's still a bit early to tell, but going forward with the fundamentals, with now the revenue, with Naivas on board, we can be able to give more light if there's any hope on the I-rate per se. But as we know, every sector has been affected by COVID, so we'll just keep an eye out. Maybe Wesley can add something.
You've covered it quite well. Thank you.
All right. Okay. So we just have those two questions for today, which I think is good, gives us plenty of time to go out and action them. Melody and Wesley, thank you for being able to cover the segment so well. You did well on your own, so we really appreciate that. To all attendees, thanks for checking in on our weekly briefing, and we'll see you next week, Monday. Remember, you can always find us on our different social platforms if you have any questions to share with us. Have an awesome week.
Likewise.
Okay, thanks. Bye.